Okay, I see we've got some folks filtering into our webinar presentation here. Welcome. We're just going to give it about a minute for other folks to be able to log on. It's great. I see the names rolling in here. Thank you for taking time out of your day to join us. And again, we'll just give it about another 30 seconds to allow more folks to log on, not miss our riveting opening remarks for this presentation. Okay, so we're just coming up right past noon here, so I'll kick things off for everyone. Hello, my name is Shana Furlong. I'm the president and CEO of the Richmond Chamber of Commerce. I'd like to thank you for joining us today for today's Lunch and Learn webinar. To start things off, I'd like to acknowledge that the Richmond Chamber of Commerce operates on the traditional territory of the Musqueam First Nation. They have lived on this land for millennia, and we're very grateful we can gather here today. So before we begin, I'd like to go over some quick housekeeping items with you. Everyone is on mute except for our presenters, but we are encouraging your questions. So this is very convenient. You can eat your lunch while asking your question. Please type it into the Q&A box at the bottom of your screen. You can even ask your questions anonymously if you need to. Please use the chat function to alert me or any of our presenters if you're experiencing any tech issues, but we really would love to see as many questions as we can through that Zoom Q&A feature. So now that housekeeping is out of the way, it's my pleasure to introduce our presenters today. Ashdown Capital is a firm that assists business owners and developers in finding financing and capital leases for their business and projects at the most favorable terms. For them, not the bank. Their team is a collection of experienced advisors who know the ins and outs of banking institutions and have an expansive network of lenders to get banks competing for a company's business. Since inception, their team has worked with companies in the micro space, as well as multinationals with over 250 million in revenue. Ben Mui, commercial and capital advisor at Ashdown Capital, spent over 9 years in retail banking with a senior lender, progressing from teller to branch manager, before exploring the commercial banking sphere as a mid-market commercial account manager. He then obtained an MBA from UBC Sauder School of Business and co-founded a corporate strategic planning business before venturing into insurance-based corporate tax planning himself. Matthew MacGregor is a principal of Ashdown Capital, Vancouver. Matthew is an experienced corporate lender with close to a decade of experience with HSBC Bank of Canada. His diverse finance experience includes commodity and trade finance, structured working capital, real estate, mid-market mergers and acquisitions, and syndications across a diversified set of industries, including manufacturing, wholesale, technology, and transportation. Finally, Kern Chiu is a principal of Ashdown Capital, Vancouver as well. Kern brings over 16 years of commercial and corporate banking experience, including Assistant Vice President of Commercial Banking with a global financial institution. Leveraging his extensive banking network and experience with clients across diverse industries, his successful financing solutions include real estate, working capital, equipment, as well as mergers and acquisitions. Please join me in welcoming our presenters for today.
Thank you so much, Shana, for the warm welcome and the introduction. And we're obviously very excited to be here and to be hosting this webinar. And given the current economic landscape, with deals being significantly more difficult to get approved, we thought it'd be of value to share some tips and best practices for business owners in regards to financing, so that you can set yourselves up for success and to set yourselves up in the best possible way to obtain the best financing offers in the market. And to start, I was going to say to begin with a quick introduction of ourselves, but Shana did a phenomenal job of that. So we can just jump to the next slide. There we go. Do you want to go back one slide, Matt?
Sure.
Yeah. Great, perfect. So I just wanted to add on to fill in some gaps there. So our brokerage was founded in 2017 by Brad Kindle, who saw a need in the market to help business owners in obtaining financing for the business. There are commercial brokerages in the market, and most of them primarily focus on real estate transactions, but there are really nobody in the market that serve business owners on the non-real estate financing needs. And that's the real impetus as to why Ashdown Capital was founded or created. We've now grown to a team of 26, and we have offices in Abbotsford, Kelowna, Langley, Vancouver, Victoria, and recently we expanded to Alberta as well. And our core value is very simple. We help our clients get the best financing package in the market, period. And a little bit about ourselves. And as Shayna mentioned, I joined Ashdown Capital in December 2021, so just about a year and a few months ago. And prior to that, I spent 10 years at BMO, split between retail and commercial banking, then spent 4 years in various entrepreneurial endeavors, and then finally finding my home here with these guys, Matt and Kern at Ashdown Capital. Matt, I don't know if there's anything you want to add.
No, Shayna's introduction was great, so I appreciate that. And thank you everyone for sending across some time to join us today during your lunch hour, and we're looking forward to speaking with you and all of your questions.
That's good. And I agree. Yeah, Shayna did a great intro. Only a little bit extra on myself is I also had a bit of a 5 years of insolvency experience in light of today's economic times, and you'll probably hear a little bit more about this later, is that banks are a little bit more nervous now when we have clients in the bank that are not operating as agreed or borderline from where their terms and conditions are. So I have a bit of an experience in the insolvency side of it through the banking side. So that's sort of a little bit about us. And maybe we can kick it off from here there, Matt.
Okay.
So a little bit of the agenda. I think it's good for everyone to kind of know what we're going to cover and how we're going to spend the next sort of 45 minutes to 60 minutes. We're going to go run through sort of some of the types of financing that is out there nowadays. There's obviously different structures, different lenders that are out there. We also want to talk about the last 12 months and the economic landscape, and more importantly, interest rates, which obviously has been a hot topic in the last 12 months. We also want to talk about packaging and marketing your own deal, how to present it best to the bank so that you get the best deal for what you're looking for. We're also going to share some case studies that we've done, which always helps relates to potentially maybe your own business and gives you a bit an idea to provoke what we've done and how we've helped people, and maybe sort of something that may fit with your case situation as well. And then we'll close off with some Q&A following this presentation. Next there, Matt. So right now, I just want to, at a high level, just talk about pros and cons of financing. Many of you obviously may already have financing in place, but it's always good to just run it right back down to some of the pros and cons. In the pro side, obviously, to have the extra financing, which we'll call from the debt side of it, borrowing money from banks directly, it allows a company to scale faster. You can always grow only as fast as what the cash flow permits, and sometimes the cash you generate internally may not be insufficient, so you need to sort of raise financing through either equity or, more importantly, through debt. Another pro is obviously having financing is negotiating power with suppliers. Many suppliers will provide you with discounts or lower pricing on certain items if you're able to buy larger volumes. So hence financing will help you with that. And also it allows you to spread out the cash and use it in other areas of your business that you may need it for, that maybe financing may help, which is sort of R&D, hiring more staff, or hiring more CapEx investments, such as buying more equipment to make your operation more efficient, or just to increase with growth. Obviously, with cons, with financing, is there's cost to it. You're paying an interest rate for it. There's could be things such as setup fees, and obviously there'll be legal costs to get the deal done, and accounting. There's also reporting requirements. Typically, if you operate without any bank financing, you may be only required to do an annual report to your account so that you can file your CRA taxes. But if you are deciding to borrow from a bank, there are reporting requirements that could be as frequent as monthly to the banks. And of course, if you're going to borrow, there is going to be sort of liability personally as well. Typically, most banks will ask for a personal covenant from you in a way that you will sort of guarantee the loans that are lent out to your company. So these are sort of some of the more pros and cons that we have that we've identified in the financing. Next slide there, Matt. So now let's just move into the types of financing. There's really different types of debt options depending on the purpose. And this is a very important thing because sometimes we do run into people where they're essentially trying to borrow for something that might be the wrong purpose. And in it, we kind of look at your balance sheet. In your balance sheet, you're going to have working capital assets, which is your AR, your inventory. Those are usually sort of what we call your short-term type of borrowing needs. And then there's your fixed assets, which is more of your long-term borrowing needs. So here we start off is that typically most clients very abundantly may borrow just to buy a property. We've known that you can now buy properties, and there's institutions out there that are willing to finance up to 100% of your purchase price, assuming that there is cash flow that permits. They're typically better rates than investment property financing. If you're trying to buy a property just more for investment purposes, banks definitely are interested in that. However, they are also not willing to sort of lend as much as they would be if it was an owner-occupied building. Also very common here in financing through the commercial side is CMHC financing in the investment property side. CMHC is an arm of the government that guarantees the loan. And as a result, most lenders may be willing to go up to 95% of the loan size of the deal size, again, depending on cash flow. Another benefit of CMHC financing is that they can also amortize your loan up to 50 years. The only thing that would determine on the years that they can lend to is the economic life of the asset. So if the economic life is less than 50 years, then typically the amortization will match whatever the economic life of the asset is. Other types of financing that we've worked on or seen is that there's mergers and acquisition, management buyout. You may be owning a company, you might have some key employees, you're looking to retire. Banks are very open to this type of financing. It could be what they call cash flow financing, where there may not also be any real assets. It may be more of a cash flow based deal, and they're willing to finance up to 75% of this type of a deal. As I alluded to earlier, there's the working capital options, which is your line of credit, where we're financing your receivables and your inventory. This is very common in most day-to-day businesses. There's also government programs. Within the banks, there's a Small Business Financing Act, which essentially allows companies that are trying to finance assets that are a little bit more, I would say, less appetite in a bank, such as tenant improvements for a restaurant. There are government programs out there that essentially allows the government to step in. They guarantee up to 90% of that loan. They take a limited guarantee from the personal principal. And these are programs that allow banks to be a little bit more aggressive on loans that they typically would not entertain. There are other government programs through BDC and EDC and FCC. EDC is the Export Development Corp of the government. BDC is the Business Development Corp of the government. And FCC is the Farm Credit Corp of the government, which provides financing for farmers. Then there's also short-term and bridge loans that are available through alternative lenders that are around. Typically, these are cash flow. They may be based on credit scores of your personal credit, and sometimes they can be as quick as 24 hours in turnaround time. And then there's equipment lenders out there that allow for financing for new and used equipment. Those are very specific, and they could be used in conjunction with a bank that you already work with as an alternative partner. On to the next slide there, Matt. So as I was talking with all the various types of financing out there, there's also various types of lenders. Typically, most people are aware of the big five banks, being the Scotia banks, the BMOs, the Royal banks, the CIBCs of the world. And then there's the local credit unions that we deal with, being Coast Capital, the Van Cities. These are all what we call our big five local credit unions that are generalists that could probably provide you with a wide array of loan options, such as real estate, M&A, working capital, equity takeout. And then, as I alluded, there's equipment lenders. Those, again, can be from the big five banks. They all typically have their own sort of equipment division. But there are also niche lenders that purely just lend on equipment. We've got a few that we've named: Dynamic Capital, Travelers Capitals. These are all specific lenders that are interested in just equipment. And again, they could work in conjunction with your current senior lender. For other businesses, there's ways to get short-term or what we call factoring or bridge financing. Factoring is a way of selling your receivables. If a bank isn't willing to sort of say finance you anymore, an alternative solution is what we call factoring. There's companies out there called Accelerated Payment or EBF, which is another company that does factoring. Merchant growth and on-deck financials, those are more your short-term bridge financing. They could typically work fairly quick and do a loan approval for you within 24 hours. And then there's just your bridge lenders that are maybe real estate backed. We've named a few in the Richmond area called Amber Financial and Gentai. They provide sort of real estate options besides what the banks can offer. They typically have maybe less stringent rules in what they want on a real estate deal. So those are another great option. And again, we've talked about the government divisions through EDC, BDC, and FCC as specific lenders that have maybe a wider band of appetite on some of the deals that you may have. On to the next slide there, Matt.
All right, so this is my section, kind of the last 12 months in terms of the agenda that we're looking at. The big thing, the big topic of conversation, obviously, is interest rates. Here's just the slide showing the Government of Canada 5-year bond for the trailing 24 months. Kind of see well over 24 months, about 2.5% increase in that base rate. This is the rate that a lot of the term loans from the banks are based on, whether that's your acquisition financing, your term real estate, your owner-occupied real estate. So outside of the floating rate, which a lot of people monitor, this is the other kind of aspect that is relevant in our business. But the last 12 months of that increase is about 2.47% increase. So it's really been the last 12 months that's been the most rapid rise in interest rates that we've ever seen. And that's kind of driving, the big talking points about the last 12 months. So that's kind of where we'll go next. So we're just going to kind of cover off the impact on financing, what's happened with transaction volumes, what's been the cascade of capital allocations in terms of banks and lenders. And then I'm going to hand it back to Kern to talk a little bit about the special loans landscape. So the big talking point about financing here has been the debt serviceability. So you see here, we're just kind of going over the last 12 months here with credit appetite at all the lenders, fewer exceptions, the credit strike zone's a little bit tighter. So, if you've been in the business a little while, you know that every bank has their strike zone on what kind of deal they want, what industry appetite, what credit metrics, what liquidity they want from the guarantors. And then there's the exceptions to that. So what you can get approved, what how your company compares to the general kind of company, the average company, you can kind of get more exceptions based on that. That's really scaled back quite a bit. So you're seeing new deals that are done really having to be the highest quality kind of deals, especially with the big 5 banks and credit unions are really looking at kind of tier 1 deals. Staff turnover, like every other industry, continues to be a challenge. So more and more often you're dealing with more and more junior bankers, and those deals are harder and harder to kind of get done. Internally, the reputation of your lender is really critical. Are they putting good deals forward? Can they monitor and make sure that this company is going to do what they say they're going to do? And can they mitigate the credit risk challenges that come along with that? So, as the business owner there or professional, are you building that relationship? Those are some things that you want to kind of be looking at in terms of how you manage your bank relationship. There's certainly been industry and asset appetite reductions in certain places among certain lenders. So investment properties is one. The balance sheet in the book and the asset allocation for the lenders is something that's really being monitored carefully. So there are lenders that are divesting or pricing out customers from their investment properties, and where are customers going to take those deals as those renewals come up. And that could be, you know, your renewal could be up in 1, 2, 3, 4, 5 years from when you kind of did it, depending on what term you took. So that is going to be an ongoing topic of conversations, which lenders are poised to take that deal from you. E-commerce has been something that obviously saw a huge boom in 2021, excuse me, with COVID, but there's been a bit of a whiplash reaction to that. You know, more due diligence on the stability of those businesses, the appetite as, you know, in-person shopping has kind of come back. So there's certain lenders that have got appetite for that, depending on what industry you're in. You may or may not be finding the challenges from your lender at this time. And trade contractors, you know, that's an area where banks come in and out of quite frequently. And in this current landscape, some lenders are aggressive with it, others are not. And that can impact everything from acquisition financing just to day-to-day working capital. So it's something that you want to be on top of if that's your industry or your industry adjacent to that with your lender. The next big thing is increase in private financing, alternative lending. So as a company, we do, you know, a pretty good percentage of our business would be with alternative lenders, but that's the segment that is growing in the last kind of 12 months for us, as companies have not been able to find what they need from their traditional lender, their big five credit union. And it's been both in growth mode for companies as well as, you know, special situations. So that piece of it, I'll kind of hand over to Kern at the end of this, but we'll kind of circle back to that. And timelines for due diligence and underwriting are, you know, increasing dramatically. So a year ago, we would have seen a deal kind of from our initial conversation with the client to submission of materials, term sheets, due diligence, underwriting and funding could be, you know, 6 weeks on just a normal kind of thing, maybe 8 weeks. And now, you know, 8 to 10 weeks is kind of the best case scenario. Other things that go into that, you know, there's increased due diligence from contracts analysis, pro forma projections analysis. So in our world, in our work, we're having to do a lot more of that upfront to support customers. And if you're out there with your lender, you know, don't be surprised if you're getting more and more questions about that type of thing, because you are getting those, or the lenders are getting those questions from credit department to find like the top tier kind of deals. I'll just move to the next slide here. I mean, this is kind of a real life example. It's pretty kind of standard owner occupied type purchase. A Richmond industrial warehouse. This is what it, you know, cost, what it sold for, what it transacted at just about 7.8 million. You know, if this is the 5-year fix that we were talking about looking at, you kind of see the base in the last 12 months. This was taken a couple of days ago. No change in the credit risk spread, but this would be your all-in financing rate and your debt serviceability. So you kind of dropped there about $900,000 that you're going to have to put in additional for a purchase now, just based on the debt serviceability. And so that has really impacted transaction volumes. Like if you're out there looking at one of these and you're doing a, you know, a question with your bank or an analysis like how much can I afford, you know, this is kind of where how things have changed in the last 12 months. So you're going to need to have a lot more equity to get that deal done. And how are you going to structure that? This was an owner occupied space. So really that money is going to come from the business or the owner's pocket. In the most general case. So that's what's driven down some transaction volumes in that space, for sure. Anything else I want to mention? There has been a couple other changes that we've seen. We mentioned cash flow lending for management buyout or a roll-up strategy or strategic acquisition. Generally, 12 months ago, a 7, 8 to 10-year amortization for something like that was definitely possible, depending on the target company. Now you're seeing, you know, much more close to 5 to 7 years amortization is something that the lenders are comfortable with. You know, interest-only periods are being constrained. There's a little bit less appetite for something like that. So it puts that pressure back on the acquisition. Again, that's going to, you know, trigger, do we really want to make this transaction at this time? For companies that are well positioned or having good equity base, it is an advantageous time, and, you know, to get those deals done. You may find less competition on those, but you are seeing the financing parameters kind of pulled back to that strike zone that I was alluding to more recently. We talked about LTVs, or the loan to value, that you're seeing decrease. And in the background, you're definitely seeing banks test not just on market rate, but on a stress test rate, adding anywhere from 50 to 100 basis points to stress test a deal prior to underwriting. So you may not see the same type of leverage, or you may be asked for additional equity on any kind of deal that you are looking at. I'll hand it back to Ben just to kind of run through some ways that we see, to help you as a customer, or in your contacts or your network, to prepare for a business loan application or a debt financing request. It's a lot of stuff that we go through with our customers, but also something that you can do on your own. So Ben, I'll hand it back to you.
Yeah. Thanks, Matt. So Matt talked a lot about, the last 12 months, a lot of lenders' appetites has shrunk, and it's a lot harder to kind of get a deal across the finish line. So we want to share some tips and best practices with you here to help you navigate around all of that. There's a lot of material and information. I'll try to keep it at a high level, and I encourage you to write down some questions at the end to ask us. And if you have more questions, you want to dig deeper with any of the items here. And so how do you market your deal? How do you ensure you can get the best financing offers in the market? I mean, first of all, you need to understand how lenders actually review commercial files. And that's typically through the 5 C's of credit. Some of you may know already, but in no particular order, the 5 C's are character, capital, collateral, capacity, and conditions. And so I'll, again, briefly go through each of the C's, and then, if you have questions, you can ask at the end of the presentation. So the first C, in which I think is the most important C, is character. And essentially, the lender wants to know, what is your financial character? If they were to advance you financing, are you good with your money? Are you able to repay? And so they'll look at typically your credit history. They will look at your financial history, such as your accounts payable. Are you making payments on time? Are you highly leveraged? So these are the kind of things that they help them determine your financial character. They also would obviously look at your character, meaning if there's any doubt to your integrity of the person that they're dealing with, typically the deal is dead right there and then. And so I would say that is the most important C out of the 5. The next C I want to talk about is capital. And essentially what this means is they want to know how much money you've invested into this business. Or in other words, how much do you have to risk? They want to make sure that you have skin in the game and that they're not taking in all the risk. Another perspective that they look at in terms of capital is, how much capital do you have available as a fallback? So in case that your business experiences a downturn, do you have capital to inject to the business or to help repay the loan? The next C is collateral. So what kind of assets do you have available to secure the loan? Will it be real estate? Will it be equipment or accounts receivables or inventory? The next C is capacity, and this is fairly important as well, is your ability to repay the loan. They're going to go through different ratios and calculation, but the one that's most commonly used is a debt service coverage, or DSC. And what that is they calculate the cash flow that you have available to service the obligated debt. So they want to make sure that you have enough to pay off all the debt. Oh, sorry, to make the loan payments. And the last C is condition. And Matt kind of talked about it earlier. The last 12 months, what's the condition of the environment? What actually impacts your industry or your business? They want to make sure that they understand that, and that there's mitigants in place to address some of the issues. So with each of these 5 C's, you want to make sure that you're clear where you stand. And if there are any risks or gaps that you've identified prior to submitting your package to a lender, you want to make sure you have mitigants in place to address them and to have them submitted along with your financing package. So again, I don't want to go through the different ratios that they look at and different mitigants, and you can happy to answer questions at the end. So the next bullet point we'll talk about is having your financials ready. Very common for a lender to ask for previous 3 years of financial statements, as well as your year-to-date financials, such as your AR or AP listings, or inventory listings, or fixed asset listings. What's also becoming the norm is a projection. So like a 12-month or a 24-month forward-looking projection with substantiating evidence. And so they want to see where you project your revenue to be in the next 12 months or 24 months. Why do you think the numbers will be there? So if you can provide evidence, for example, you have contracts that are signed that you anticipate to execute, et cetera, that's going to really help to support your case. The next is a SWOT analysis. So SWOT stands for strengths, weaknesses, opportunities, and threats. And so that's something that we encourage everybody to do actually from time to time, because the strengths that you have today may not be a strengths that you have tomorrow, because the market is changing so rapidly. But that's a process or analysis you want to do, and again, submit it along with your financing package. You want to tell your lenders, what are your strengths? What are your competitive advantage? What are the weaknesses that you have identified? And what are the mitigating factors in place that you have to kind of address some of these weaknesses? What are the opportunities that you've identified that you may want to either explore? Could be a demographic market that you want to enter, could be a geographic market you want to enter, could be a product line expansion. You want to be able to identify some of those so that the lenders know that you have a plan in place. And last but not least, for SWOT analysis is the threat. So threats of new entrants coming into the market. How are you going to combat competition? You want to, again, have some narrative around that. And we talked a lot about the key risks and mitigants, and that's kind of the theme that you want to have and again address for whether it's a 5 C's, whether it's SWOT analysis. You want to make sure you have done the due diligence to identify the risks as well as the mitigants to address those risks. So in terms of other considerations in the commercial financing space, it's very different than personal financing or a residential mortgage. In terms of residential mortgage, typically there are only 2 things that people consider. It's the loan to value, which is the financing amount, as well as the rates, which is typically the same across the board. In commercial financing, you need to consider covenants, guarantees, the rates, amortizations, fees, etc., that we kind of listed out here. And so going into before you reach out to a lender, you want to have an idea of where you want to be with each of these items. And we'll speak more to it on the next slide. And the last but not least is a timeline. Matt talked about the timeline previously. We can get from engagement to having it fully funded about 6 to 8 weeks time. Right now, the best case scenario is 8 to 10 weeks, if not longer. And so you want to make sure you have that expectation, particularly if you're putting an offer to purchase, let's say, a commercial property, the subject removal date, you want to make sure you're giving yourself at least 10 weeks out so that you have enough time to get an approval in place before you remove subjects. Matt, if you can do the next slide.
Yeah.
And so the last thing that we want to share with you in terms of best practices is to reach out to multiple lenders to obtain financing. So there's a misconception in the market that your home bank is going to be the best bank, that's going to give you the best leverage and the rate, and that's oftentimes not the case. And we talked a little bit about the other considerations in terms of amortization or fees or rates, etc. You won't know what is considered market if you don't reach out to multiple lenders. And so one of the recommendation we have is to reach out to at least 3 to 4 different lenders for your file, especially if if you have a very solid business, strong cash flow, strong equity, strong security. You definitely want to go to the big 5. They would be lending to the tier 1 clients. But let's say your cash flow is tight or you don't have sufficient security. That's when you really want to reach out to beyond just the big 5 banks. You want to perhaps reach out to credit unions or other banks that are not, could be National Bank or HSBC or CWB, that are not just the top 5. And that way, again, you get the banks to compete for your financing, for your business, and you also can confirm what is considered market. Anyways, next slide, please.
Thanks, Ben. So here we're just providing you with a bit of a visual presentation of a file that's actually ongoing right now. As Ben alluded to earlier in the previous slide, the lending landscape is changing. The bank's appetites are always changing. And here is a scenario of what's of something that I'm working on right now. On the existing bank, I'll give you a bit of a preface. This is actually a client that is operating as agreed, but something of when they were onboarding the account that only got realized when they did their annual review is that there was a bit of a margin deficit on the loan. And as a result, the client has been sent into their special loans group. The client has the money to mitigate this issue, the security breach. But at this point in time, the client feels that the trust has been broken when they've got originally marketed about 18 months ago to this new bank, and they were given a low-hanging fruit, which is a very low fixed rate for their commercial building. As a result, the client has come to us and said, you know, I need to go through a proposal right now. I need to market my client to see what the other banks would be willing to provide. And as you can see, with the 4 banks that we've gone to, every bank has a different appetite for a certain amount of deal. And this is really more just like if you want to compare your investment portfolio. Banks carry asset classes as part of their portfolio. And so as a result, banks could price things sharper if it's an asset class that they really want. And if they don't want the asset class, they will simply just price it higher. And that way they know how they could sort of, you know, balance their portfolio to a level that they're comfortable with. So for this deal that we're talking about, you'll see that Bank 3 and Bank 4 really wanted the business. And as a result of that, they were able to leverage the real estate at a higher amount than what the existing bank was going to be able to do, or Bank 2 or Bank 5. As a result as well, you can see that Bank 3 was very competitive on their variable rate pricing. But then on the fixed bank rate pricing, you can see that Bank 2 has much more considerable lower rates than the other banks. Another thing that may be of interest to you, you'll see that is Bank 5 was willing to look at the real estate and amortize it over 30 years versus the other banks went for their conventional 25-year amortization. So what I'm trying to say here is that it really depends on sort of what is motivating the borrower or the client. Some, it might be just purely leverage. So if you are looking at it that way, Bank 3 and Bank 4 would provide you with the highest leverage. If you're purely just looking at rates, you know, on a variable side, Bank 3 is better. If you're looking at fixed rates, Bank 2 is better. And then if you're looking at just like your guarantees, bank number 2 is limiting their guarantee to only $2.5 million, albeit you are also getting less money. Versus if you're looking for maximum leverage, Bank 4 is going to give you that, but they're going to want a full covering guarantee from you personally. And then another thing that is always up for negotiation is your application fee. These are all subjective. The banks charge based on sort of a guideline, we'll say, but that doesn't mean that that's what they're going to have to charge. So as you can see here, even though a Bank 4 is going to lend you $19.5 million, their setup fee was probably the cheapest at only $15,000. So again, these are a lot of things that, you know, like buying a car, borrowing money at a bank is very negotiable. And so this is just more of an example of showing like banks have appetites for certain things, and they will price things sharper when they have high appetite for it, and they will price things a little bit more expensive when they have low appetite. Next slide there. So now we're just going to talk a little bit about some case studies. That's we've sort of concluded more of the factual stuff of our of the business of our presentation. The case studies is just something that maybe allows you guys to relate something on more personally to your own company. As I mentioned in the very start, I did spend 5 years at a special loans group at a big 5 bank. And as you know, in the last year or so, the rates have increased tremendously. And as a result, the special loans groups at every bank is getting busier. I think if you want to step back, as of 3 years ago when we were going through COVID, the government came up with a lot of programs, being CEBA and the Canadian wage subsidy. Well, for over a year now, those subsidies have all dried up. So essentially, most businesses have to sort of be able to stand on its own 2 feet without any financing. Also, during that time, any files that were sort of borderline, the banks were not calling loans or transferring them to special credit because they knew that from a reputational standpoint and really of like solution, there was really no solutions that a lot of the banks could offer the clients. They had to just work through what they know in their business, and hopefully they can sort of weather the storm during COVID. Now that COVID is really in the back door or the back view mirror of us, and we are sort of moving ahead, loans that were sort of teetering on borderline and haven't recovered are now actually being acted on, and there's exits being occurring at all banks based on my experience. And a lot of these loans are dealing with issues such as breach of covenants, out of margin or out of security position where the security has eroded to a point where there's a deficit. The financial health obviously of the company has eroded to where there's maybe negative net profits. And so this has caused a lot of the banks now to start exiting relationships. So this is sort of what we're seeing right now. And it's going to be a more and more common theme is in our view, or in at least my view, based on the number of calls I'm getting from the bank. So it's just more of an FYI that, make sure that you're understanding what your current bank's terms and conditions are. If they're meeting and you're having ample room in your covenants, then you should be fine. But if you are borderline and you feel like you are going through a bit of a downturn, the biggest thing that I can offer is to be transparent and communicate with your bank. It's situations where human nature is that if things are going bad, typically business owners will try to hide or not try to be fully transparent with the bank, and that's kind of when you get into real trouble. So I will, promote that transparency and communication are key when times are tough, because this is when the banks could at least evaluate your situation and be able to provide you some solutions. So next slide there. The next case study that we want to talk about is professional financing. I don't know if any of you in the audience are in that space, but many of the banks are offering very attractive rates if you're in the professional space. And by that means in the medical services, whether you're a dentist, a doctor, optometrist, a veterinarian, or other professionals such as an RMT, chiropractor, or physiotherapist. All of the major 5 banks have a lending program out there. We want you to make you aware of, and that financing could be like equipment or tenant improvements, where you've just bought a new strata retail and you need to fit it out with tenant improvements for the office, and also some working capital. Most banks are now offering a prime minus product to most professionals in the healthcare space. So this is just something just for you to know if you have anybody that you know that it's in the sort of the professional space. Yeah.
This was another section that's kind of relevant to the marketplace, especially in the Richmond market. So distribution, wholesalers, manufacturers. There's just a structural difference here. We talked a little bit about on Ben's slide about the 5 C's and the different ways to evaluate a deal, pricing, LTV. One of the big things right now going on for a lot of customers in this space is that the just-in-time kind of inventory supply chain has changed a little bit to just in case. Companies have been having to stock more inventory. A little bit has been the fact of not being able to get inventory for a long time, having a bunch more, but there's also like a concept here where you're having to have more, and that impacts your balance sheet. You want more inventory in relation to your accounts receivable. That can lead to a working capital challenge with the structural solutions that different banks apply. So, we've kind of listed some solutions here that can be advantageous for companies in this space. Asset-based lending is a way to look at the real-time or as close to real-time value of your inventory as AR as possible to get a higher loan to value and without some of the structural caps that are often in place with a line of credit facility. There's also inventory financing specialists in the sense of, that is asset-based lending, but like non-bank asset or inventory financing, especially if you're in say, the e-commerce space and you really are direct to consumer. I think that the thing to highlight here is just that there are alternative solutions and other capital providers beyond what's happening just at the kind of big 5 banks and credit unions for companies in this, and now could be a time to explore some of those options. Factoring facilities, just Kern mentioned the purchase of your AR. There's a couple of different ways of looking at it. Real purchase financing against notification, non-notification, but ways to delever your balance sheet, also to improve your cash conversion cycle. All relevant topics, especially today, for all industries, but especially in the distribution, wholesale, manufacturing kind of area. And so, line of credit is one solution. AR insurance is something to mitigate your risk. And we talk about government solutions. EDC is a big player in promoting the export for companies. And they do provide some solutions to support different structures for customers in this industry. So a lot of it's kind of changing and giving customers fits right now. So just some options to consider, to explore if you're in that space. And then this hasn't been a real estate focused presentation, is broadly commercial banking, but real estate's a big component. So, for business owners, what's happening in the owner occupied space, we gave a case study here about the loan to value changes just based on the debt serviceability. But also there's a lot of changes for investors and developers in the space in terms of development cycles, land acquisition financing, construction financing, how you're going to create that capital stack with potential additional equity requirements or mezzanine structures on those deals, inventory financing, ultimately term takeout. So there's a lot kind of happening in terms of where deals are sitting, and banks, big five banks, especially credit is looking at tier 1 or tier 2 deals, and some of those deals having to go to alternative lenders, and some of those deals that sat in, alternative lenders having to go down market. So a capital cascade kind of reallocation is happening in that space, and it's something to be aware of. That there is appetite for your deal. Most likely, it's just not always going to be the player that maybe it was 12 months ago. And I think that kind of general concept applies across, special loans, distribution, trade financing, real estate. So you might have to work a little bit harder if you are trying to place a deal, these days, and that's something that we help clients with. But we've also tried to give you the tools today to kind of look at some of the solutions and a way to look at some of those solutions for yourself. So for us, that's kind of the cap on the information side of it. So we'd love to throw it open to some questions if there's been some questions in the chat or otherwise.
Thank you so much. I'd love to thank our presenters today. That was a lot of really, really useful information and very specific, which I love. I know that was a lot of information. So if you're on the line and you have a question, I'd love for you to pop it in the chat in the Q&A function at the bottom of your screen. I see one hand up among our participants. If you have a question, if you wouldn't mind throwing that in the Q&A function, and I'll pose it to our presenters now. But I'm going to start things off if you don't mind. Which bank are you finding is most aggressive right now in general?
I think that really all depends. Sort of like if we went back to the slide that I showed the comparison of a deal and which bank came out, there was 4 banks were all interested in it. But each bank has their own appetite at a specific time on what they're most aggressive on. So there's definitely, I think all banks right now are super aggressive on owner occupied buildings. They definitely love that because it brings in the operating business as well. Another key thing right now the banks are wanting, and it's not even a lending product, is deposits. So as you know, in banks right now, the borrowing is much higher. The rates are much higher. So the banks need to build up their balance sheet because due to OSFI regulations, all banks have to back all their loans with a bunch of capital. So the capital adequacy requirements requires them to have a certain amount of cash sitting in their balance sheet. So one way that they could raise that money is through clients themselves. So they're actively right now looking for cash deposits. So if you are able to, if you're a business that sits on a lot of cash, but yet you also borrow a little bit, typically you're going to be a favorite client of any bank right now. There are some banks right now that aren't too keen on investment property, just in the view that rates are higher right now. So, and unfortunately, cap rates are still fairly low. So we're still leaning towards that. Real estate hasn't gone down. The rates are higher, so it doesn't make a true strong investment decision for most buyers to buy an investment property where the return is still so low.
Oh, that's interesting. We hear a lot at the chamber about how lease rates are so high. And right now, I think we have 0.3% vacancy rate on industrial land in Richmond or the region. So it's good to hear from the other side.
It is catching up now, Shayna, but I think some people are still stuck on sort of like a 5-year lease rate where they're still near the tail end, and that lease rate is still fairly low. And it's funny you say that, but a lot of times we're seeing clients that are wanting to buy because their lease rates have literally gone up 40%. So landlords are catching up right now. Like we have something in Richmond that's gone from $13 to $23 a square foot. So when clients see that, they're saying, well, why don't I just build my own pocket and versus padding the landlords?
It's a great point.
Yeah, there's definitely a latency to some of these things, right? You have to work through that lease turnover kind of before the average lease rates will all go up and there'll be a cap rate adjustment to it. So we have seen some scenarios where the appraisals are even coming in a little bit below based on comparables to what the purchase price is. And so that's been causing some issues, right? Because the banks will look at the lower of those values. So that the rate increase was so quick. I tried to highlight the last 12 months, right? That doesn't line up with like the average, if you want to call it 5-year leases are kind of common in commercial. So what's the average on that? Maybe 3 or 4 years. There's a latency, a discrepancy between those timelines that hasn't kind of filtered through the market. And that's one of the things that's driving transaction volumes. But I just wanted to add on the question about what banks are most aggressive, it is to echo Kern's point a little bit. It really depends, right? If you are in, the contracting space, there's a couple of banks that are aggressive in that. If you're in the e-commerce, if you're primarily export focused on the construction side, we've had a deal that went out recently that there was 4 banks interested, but one was absolutely head and shoulders above, both in terms of like loan to value, insurance requirements, personal guarantees, holdco guarantees. So they really competed on structure rather than on rate. And the client was thrilled with that, but it was kind of, everyone was kind of table stakes, and then there was one lead horse that really wanted to do it differently. So it kind of speaks to that point, to take it to market simultaneously to see what's available. And it could or it could not be your home bank, because you don't know what's changed in their appetite since you started working with them.
That's great advice. And I think that's one of the pieces I'll be taking away today, that 3 to 4 different lenders take it to market simultaneously. There's a follow-up question to the last one. I see there's a few that have come in, so we'll make sure that we get to all of them before we go today. Wendy Lee asks, what about downtown office space? There's lots of vacancy. Do you think banks are interested in it right now? Or will banks be interested in it?
I know from a retail standpoint, there's a few banks that aren't looking at retail space right now. And if they are, they're looking at loan to value less than 50%, and that's assuming there's debt service as well. So just I know that we've got one that we did close, and I think Ben and Matt are working on it, and it actually had to go through the private route. So then I think that's right by Waterfront. I think, is that the one there, Ben and Matt, that was a strata retail
office space.
Pre-sale.
Yeah. So I think, yes, the lenders are still interested in office space, especially the tier 1 office space. But like Kern mentioned, you're not going to get the 70 or 80% loan to value or financing. You'd be lower LTV, maybe closer to 65, unless you have other security available, such as another corporate guarantee or strong personal assets. But otherwise, you're looking at a lower LTV versus other asset classes, such as industrial property.
Mm-hmm. Yeah. Thank you. An anonymous attendee is asking, does Ashdown Capital assist with institutional fundraising and private equity funding?
Yeah, no, not at this point in time. You need to be an exempt market dealer to do that for any kind of equity type raising. To be honest, none of us actually have dealt with in the equity side of it, so it's a bit of a different beast. We'll just say that we are purely just debt lenders here, or debt raisers here, so that's kind of where we specialize in.
Thank you, and thanks for that question. I see another one here from Matt with Purpose CPA. He is curious to understand how to structure trade finance products to reduce cash to cash cycle for manufacturer wholesale. And what is the LTV on inventory and AR? And if AR is insured or EDC guaranteed, how much can LTV increase by? And I am going to challenge you to explain what these initialisms mean in your answer, so that all of us who aren't CPAs or in the financial sector really understand what we're talking about.
Sure, yeah, I can take that one since it's specific to trade. So on the EDC question specifically, I think I'll work backwards. Hopefully I don't miss anything here. The insurance, generally, you can get 75% loan to value on uninsured accounts receivable. Generally, that's both Canada and US. Most banks treat the cross-border aspect of the same. So that's the counterparty is a Canadian or US corporation. If you insure it, and EDC doesn't have to be your only insurance option, there are other players out there. which is important to know because, you know, limits and coverage on the name is critical, but you can increase your loan to value generally to 90% on that. It's an insurance policy where the bank is the beneficiary rather than a guarantee. If that's what the line of credit structure is, pretty standard. If you're looking at like an ABL type structure where there's more regular monitoring of those accounts receivable, and there's also more kind of transparency around the dilution on it, you can get anywhere from kind of 75 to 85 on a named basis without insurance. So that's a solution, but that's a structural issue depending on how your lender is structuring your deal. And then I think the rest of the question was kind of about what are loan to values on inventory and how do you change the cash conversion cycle. So, I mean, supplier credit is the biggest credit aspect in the marketplace. So that's always something that's good to get. If you can't get it, then there is solutions where you can provide either letters of credit or standby letters of credit to try to get the suppliers to extend you longer terms. That's usually the cheapest way to do it. You're mitigating both their payment and their default risk by using those instruments. In that case, you know, you start there, and then you're looking, if you're importing, you've got either raw materials or finished goods, and you're trying to add value to that WIP. If you're a manufacturer or wholesaler, you're generally kind of breaking down boxes and transporting. So you're looking for inventory values. Often the loan to value on that is 50%, often capped on a line of credit at 50%. There are situations based on the obsolescence, perishability, and quality of the borrower where you could get 60%, 60% caps. In an ABL structure, you can get a little bit higher. You're kind of talking somewhere around 70% of net order liquidation value, which depending on the industry, that can be higher or lower than your cost. So it can be a structural advantage to look at something in the ABL space. The other cash conversion concept there is that the balance sheet, and especially the CBS in the question, if you are accumulating more inventory, you're also usually capped on your structure based on equal representation of AR and inventory. So if your balance sheet's more heavy, you're actually going to end up with a much lower overall net loan to value on inventory with a strictly line of credit solution. That's where an ABL or specific lender kind of solution can come into play. And then the other way to close the gap on the cash is on the AR. So we talked about the loan to value, but there's also factoring solutions, which can be true sale. You're either lending to get it or you're getting cash in directly. The true sale can help, you know, lower the overall leverage on the balance sheet. And it can also, you know, kind of provide a real-time solution depending on what your structure is. If it's a manufacturer and you've got a well-diversified portfolio of AR, it's not a problem. But if you're maybe a trader and you need to get the cash closed straight away and you have fewer contracts on the book at one time, or a concentration around AR, you know, a factoring solution can be an option there to kind of close that cash conversion cycle and turn that money over faster for that industry. So that's kind of like a wholesale answer there. I think it covers all the bits, I hope.
Thanks. And Matt, if you want to pop into the Q&A, if there was any other piece that you had to ask there. I think we have time for just one more very, very short question before we wrap up for the day. So I'm going to ask all of you. We've talked a lot about interest rates and what's happened to those over the past year, the past 12 months. What are you recommending for clients right now, locking in or floating rate?
Our consensus has been actually, if someone wants to lock in, is that you don't go anywhere beyond 2 years. We feel like obviously the government has done what it has to in raising prime to the point where we're at right now, 6.7%. And then all is probably tied to inflation. So we feel like that once that stabilizes or starts to go down, that we should see the trickle effect of now needing to sort of drive the economy to sort of bring it back to where it was before. So the only way you can do that is to lower rates. So most of our guidance to our clients is not to be more than 2 years. And that's sort of what we're seeing in most, when we talk to some of the bankers, that's kind of what we're seeing from them as well as what their clients are deciding on.
That's great. Thank you. Now, I'd like to thank you all, Ben, Kern, Matthew, for sharing that great info with us today. I hope everybody learned something. I know I did. This Video of the presentation will be available on our website in the coming week as well. So if you missed something and you want to review, pop over to the Chamber's site and check it out there. Before we part for the day, for anyone who would still like to snag a ticket to this evening's Vancouver Whitecaps and Richmond Chamber event, please shoot me an email in the next hour and I can still snag you a ticket. And I also hope to see you all at the March 23rd Business After 5 at Axnix Technology. So thank you once again to Matthew, Ben, and Kern for joining us today, for sharing all of that great information and their time. And thank all of you for taking the time to join us.
Thanks, everybody.
Thanks,
Thank
everybody.
you.
Thank you. Have a great rest of your day.
I know.
Bye-bye.